Hello, everyone. And once again, an official welcome back to our new Blueprint strategy course. What we've done so far on the COT is we talked about one of the three participants so far, the users and producers, the so-called commercials. What's left are the non-commercials, as well as the retailers. In the last couple of sessions, we already teased the retail trader a little bit and how they usually act in the marketplace. But today, I want to talk about the retailer more scientifically so that we can really also put some rules around how to use them in our blueprint strategy. A couple of care points here. This is an Excel that we worked on throughout the entire session last time. And this is something that I want you to continue maintaining for all of your favorite markets, because this is really going to help you at the end. So today we're going to talk about the retailer, and we can continue to populate this Excel spreadsheet as we look at the wheat market. What we can do, but what we will probably not do, is to populate this kind of sheet for all of the markets that we are going to start to cover, because there's just not enough time to cover all of this. So we need to be a little more efficient in how we operate. But for some markets, we will do this together. And then hopefully this will teach you how then you can do this on your own as you may be approaching other markets as well. What I also did with this Excel spreadsheet is I actually populated it with the actual numbers in terms of the losers and the winners. And what I did in terms of catering for confirmation buys is I just added an additional loser to all of these different rows, right? So whatever I had first was basically one less here. And so I added one here, I added one here, I added one here. And this was just to cater for potential confirmation buys and just catering for, my eyes that may be tricking me every once in a while, where I would say, well, hey, here it really works, but in reality, it didn't work that well. So to cater for that, I just added basically 1, 2, 3, 4, 5, 6, 7, 8 additional losers to this sheet. And I just wanted to mention this because if you do this on your own, depending on where the starting point is for wheat, you may get slightly different numbers here in terms of the winners and the losers, right? Depending on what your eye sees in terms of, hey, that was a winner or that was a loser, in terms of what you would have expected from the move. So to cater for that, for the different numbers, I just added losers on top of that, right? But then still you may be getting different numbers, then you know where the difference basically may be coming from if you do this on your own. But still, even if I add the losers, we have a pretty high accuracy across the board, right? Something that we can really live with. And what's going to be interesting later on down the road is if you were to populate this as we go, right? And then you would add gold and gold and gold and so on and so forth. Eventually, you could create a pivot table, right? And that pivot table, then you could say, well, I want to see wheat, I want to see gold, or you don't want to have the market split. You want to see the end of the band. You want to see the end of the band split without the buy or the sell, right? Or you want to see the trend following, regardless of buying or selling. And or you just want to see just wheat, right? In terms of all the losers versus the winners on all the strategies, and you want to see the total accuracy. And so you can then play around with then eventually a pivot table where you add and you take away certain strategies or certain tools, and then that's going to spit out an amount of winners versus an amount of losers. And then you can also come up with ideal strategies eventually. Of course, I'm going to give you the blueprint on all of that, right? But this is as you maintain and populate a table, that's going to be really nice for your overall understanding. Of course, this is not sustainable in terms of future maintenance, right? Because that would mean for every market, for every strategy, we have to maintain all of the losers and all of the winners for all of these markets whenever things change. So in terms of maintaining this for the future, that's not really sustainable. We need a computer. We need the computer to do this eventually for us. And this is something that we're working on as we speak. However, what this does do is it gives you a clear strategy in terms of also, okay, what is the accuracy? What is the probability of success? And what are the kind of tools that work? And it allows you to understand the back testing a little better, right? Why it's so important to back test, because back testing allows you to understand a market much better in terms of what are the key fundamental drivers of the markets we trade. Remember, that's what we want to find out. A good trader knows the markets they trade. A good trader knows the fundamental drivers of the markets they trade. So how do we get to know the fundamental drivers of the markets we trade? Well, first of all, I give you a blueprint of what generally works and what doesn't. However, as it's then specific to the market, you can then go in and say, well, this really works the best for that market. And it may be that for some markets, it's the retailers, just observing the retailers works the best for some markets. And then for other markets, it may be the COT index. And for other markets, it may just be the seasonality tool. And for other markets, you just need supply and demand, right? And so you'll really, in doing an extensive back test, and this takes a lot of time, right? You'll really get to know what drives a market and what generally works for a specific market. And it's not the same for all markets, unfortunately, right? So the conversations that we're having from now on, unfortunately, are going to have to become rather complex as, again, I can give you a blueprint, but then within that blueprint, there's a lot of gray and leeway that you can operate in, right? There's a range where you can operate in. But I'm really going to try and hold you by the hand. And for the markets that we go through together, I'm going to give you lots of insights on what generally I found works the best for each of those markets. So now going back to the retailers that we want to talk about today, this is basically what we are going to cover. So there will be two strategies on how we implement the retailers into our blueprint strategy. One, which is just using the retailer as an additional fundamental odds enhancer, very different to the commercials, because the commercials are really the smart money that we want to follow regardless of what anyone else is doing. When we look at the retailer, we may not want to simply do the opposite. Just because they're buying doesn't mean we just want to be selling, right? What overrides that is what the commercials are doing. So we look at the retailers as just an odds enhancer generally, but there's one way on how we can also look at the retailer as a standalone fundamental tool, okay, that we can follow. And I'll show you how this can be done. And then, of course, I'll try to make as many practical applications today as possible. So who are the retailers? Well, I can give you a very technical explanation for that. And the technical explanation is very important as well. And I tell you why in just a second. Let's go to our CFTC website and let's just get our futures only reports for, let's say, the commodity exchanges. And let's look at gold, because gold is what is open here as well. So if we are looking at the net positions, longs, and then subtracting the shorts from the longs, again, we're looking at the non-reportable positions. So who is a non-reportable position? Well, for sure, you and I were non-reportables, right? However, what makes us, technically speaking, a non-reportable position? Because I could have a business where I trade real physical gold. However, I may have a business where I trade very little real physical gold. In that case, I wouldn't be a true large trader in terms of I wouldn't be categorized as a reportable position. So in other words, there is a contract cap what will put you into the reportable position. And that contract cap is 100 contracts. So if you are someone even that trades physically, you're in this market, you're trading below 100 contracts, you're still a non-reportable position. Okay, so generally speaking, those non-reportable positions, they are rather small, right? It's very rare that someone has 99 contracts on the table, right? It's either someone has a lot of contracts on the table or someone has very little contracts on the table. So if you trade below 100 contracts, and I'm just assuming everyone, including myself in this room, would be trading below 100 contracts, we would all fall under the category of non-reportable positions. Now, we don't have to report what we do. The reportable positions, they have to report what they do. However, whenever we trade or whenever we enter a central marketplace, we would still be captured within the overall longs and shorts. So what they basically do is they just take the total and they subtract the reportables and they're left with the non-reportables. And then the non-reportables, the longs versus the shorts, is what then would flow into the retailer graph here. So again, we'll have a Campus COT retail trader, and that will track the net positions of the retail traders. So they represent the public for most products. So the retail traders as a group, we know them to be notoriously wrong most of the time. All right, they're not wrong all the time, but they're the most inconsistent player in the game. When their long exposure is extremely high, meaning they are extremely bullish or extremely greedy, in other words, the market usually goes down or is about to go down, right? The market usually tops. And when they're extremely bearish, or in other words, when they're extremely fearful, the market is usually about to start a rally, because these people, they may be right for a while, but they cannot be right for a very long time. And that's also not my opinion. We can see that over and over again as we look at the COT net. And as you just look at this chart right here, which is the gold weekly chart, you can also observe that there is a 3-year high and there is a 3-year low in terms of the overall contracts that the retailers have on the table, in terms of the nets. Right down there, all of them together, they have 10,000 contracts long. Up here, all of them together, they have 45,000 contracts long. And we know that this was the 3-year high, and we know that this was the 3-year low in terms of also price. So there's a relationship between what the retailers are doing as a whole and what price is doing overall, right? And usually what the retailers will do is they will follow the overall direction of the market, which is why, looping back to the direction exercise, which is why the conventional trend analysis is a lot of time very misleading, because by the time that you see that trends are formed, like here, for example, right, we would have, wow, we would have a downtrend. That's amazing. So what do we want to do? We want to sell and sell and sell. And so they're all selling. However, they're at a 3-year low in terms of their exposure, right? So I can't go to the left here, unfortunately. However, we know that in the last, since 2021 or 2022 here, they haven't been that low. So it's the lowest that they have been. And what do we see as a result? Well, if we follow the trend, we're missing that the trend is potentially ending here. And of course, only if we saw the commercials buying at the same time. And vice versa, right? If something has been uptrending for a very long time and it's been rallying for a very long time, and then we would say, well, the trend is up, eventually the retailers will be at such an extreme that the market just has to flip-flop, right? The market just has to go down. So what you will notice is that following the trend usually is not a very good idea if there's a very long trend in place. And how do we see if the trend is rather about to end? Well, we see it within the extreme readings of the COT report, right? And I'll show you on other markets as well what that looks like. Now, what we have to do is we have to put all these other extremes, right? So this as a potential sell, this as a potential sell, this as a potential sell, and then we also have to put this as a buy, this as a buy, this as a buy, and of course this as a buy. And how we're going to do that again is we're going to look at our COT index, right? That's going to look at 6 months, and then it's going to say, well, this is a 6 months extreme, 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 and so on and so forth, right? And so what then our index does is basically puts that into an oscillator where you will have those extremes that are going to be picked up by our COT index. And then how again we're going to use that, I'll just show you in a second. But it's important for you to just visualize that when we say that trading is a zero-sum game, and usually there's someone always on the other side of the trade, that someone who's on the other side of the trade is usually the retail trader. And it's all relative, right? If you just tell me they have 45,000 contracts on the table, it means nothing to me. I need to know what is that relative to in which time period, right? Is that a 3-year high or is that a 3-year low? Because also 10,000 contracts could be high if the backdrop of that was like this, right? Then eventually this would be high. So I need to know what the backdrop is, and I need to get a baseline, and then only I can say whether a certain number of contracts overall nets is an extreme or not, right? So basically the nets, they don't really matter that much. What matters is the look back in terms of, is that really an extreme? And if so, is that a 6 months extreme? Is that a 3-year extreme? Or is that a historical extreme, maybe even? And depending on that, we can then argue either a little bit of a bounce or a longer term move or a big move to follow. And so what we can see is when they have relatively high contracts, the market is about to go down. And when they have relatively low amount of contracts, so when they're very fearful, we should be buying, right? So we basically do the opposite of what these guys are doing, or at the very worst, we avoid doing what they're doing. So we don't necessarily have to do the opposite. We can just avoid at times doing what they seem to be doing at the moment. For some markets, however, and there's a caveat to that, this group is usually doing a pretty good job. And that's primarily in the agricultural markets, and some of them like the meat markets, like lean hogs or live cattle. And the reason for that is because there may be some commercials here that are just trading less than 100 contracts, right? Because if you talk about smaller markets like live cattle, lean hogs, or even wheat, there's not a lot of retail traders that trade that. And some of the retail traders that actually trade that are not retail traders. They're just disguising as retail traders because they're trading less than 100 contracts. So some of them are actually commercials. They know what they're doing. They really know this market in and out. And they have been following this market for years and decades because that's their job, that's their business, and they're just in this market to facilitate their business activities and needs. However, because they are trading lean hogs or live cattle and they're small, they just can't afford to trade 100 contracts. So it means they wouldn't be reportable, they wouldn't be they wouldn't fall into the category of reportable contracts. So that is where it becomes kind of important, and I'll show you that as well. This is our wheat chart, right? Our wheat chart is what we talked about extensively the last time. Commercials we can see, right? And we talked about them extensively. We don't have to talk about them again. However, what we now can do is I can now just double click on this indicator and I can see the speculators right here. And the speculators, I can just turn them on or I can turn them off. So if I put a true there, I will turn them on. And what I usually also do is, in terms of the style, I just want them to be a bit thicker. I'll put it as a default. And here we go. So now I have the retailers as well. So what do you see actually is the retailers are pretty much aligned with the commercials. Yes, they're a little bit different. They're a little bit off. They're not exactly the same, but both, you know, if you're following both of them, they are very accurately tracking each other. So then you may be saying, well, hold on a minute. They're basically one and the same. And then I would have to say, yes, of course, they're one of the same. And then I would say, as a counter argument, I would say, well, name one retail trader apart from us who's trading wheat, right? Apart from Nader here in this room. Because even myself, I'm not necessarily trading that all the time. I know Nader is trading this and he loves to trade that, right? For a reason, and because the commercials are so obvious here. However, if we were to do the opposite of what the retailers are doing here, we would be doing a pretty bad job, because the retailers most of the time are doing, and here as well, what the commercials are doing. And the reason for that is that the retailers here are not actual retailers. They're just commercials disguising as retailers because their position size is not large enough. It's not above 100 contracts. It's below 100 contracts. So therefore, they would be disguised here under a retailer umbrella as per the COT. And that is where it really becomes important that we, you know, are tracking this and that we know this. This may be the case, especially for agricultural products. And then if we see that they're aligned, then now here comes my spreadsheet. Now, right? Retailers, well, for wheat, what are we going to put here? Not applicable, right? Not applicable. Job done. Not applicable. And so now you know for the rest of your lives, when you look at wheat, when you're going to filter on wheat and retailers later on, well, they're not applicable, right? I don't have to look at that at all, because they're basically anyways doing what the commercials are doing, because most of them are commercials. And the few of us that are within those contracts, we're so small that we basically don't make a difference in terms of the overall moves. So that was pretty quick, right, in terms of wheat and the retailers. And that's going to be the case for a lot of agricultural markets. And so I just wanted to mention that here as well, that it's not always the case that we do the opposite. So then you may be saying, well, how do we use them, right? How do we use them? Well, we use them in two ways. Number one, as an additional fundamental odds enhancer. And here we would just be looking at divergences, and we would align those divergences with one of our large traders, mostly the commercials. So if the commercials are setting up nicely, then we're like, hey, that's a pretty good fundamental setup. We can trade it regardless. And then if the retailers are on the other side, if there's a divergence between the commercials and the retailers, then we could say, well, now even better, right? This is what I have been waiting for the perfect setup, but you don't need that setup. It just becomes an additional odds enhancer. However, we can also use it as a standalone tool. And this, for the standalone, we would have to look at the COT report, and we would only look at historical net position. So whenever the retailers are at historical extremes, that's when we pay attention to the retailers. And then regardless of what we see anywhere else, we just do the opposite, because that's so rare. And when it does happen for some markets, it creates some crazy moves. And maybe we'll have some time here as well so that I can show you. And what I mean by divergence is, we teased that the last time. Here you can see also palladium, when the commercials are on the one extreme and the retailers are on the other extreme. That's a divergence, and that is now an odds enhancer for us. Now, the retailers, they don't have to be here, right? They just have to be on the other side. So just because they're at the extreme here doesn't mean that the retailers have to be at the exact opposite extreme. Of course, if they were, even better, right? Here, for example, they are at the 3-year extreme, and then also the commercials are at the 3-year extreme, and that's what was a really huge rally in price. However, every time else, when they're, for example, selling here, and then, oh, the retailers are at the 3-year extreme, even better, right? Now we look to sell, and then we also get the sell, or here the commercials are buying here, and then the retailers are on the other side. That's a divergence. And then we also see a little bit of a rally here as well over a few weeks here too. So we are generally looking for divergences. And when we do get a divergence, that would be generally an odds enhancer. And if we don't have that divergence, we could still take the trade. However, that could also be a reason for us to say, well, maybe I'm going to wait until the retailers are on the opposite side for them to really take a stab at this. And then the historical COT net is what would come in as a standalone tool, okay, for us to take decisions on for some markets. So on wheat, we said, well, we really don't need the retailers for wheat, right? So what we then would do is we would double click on this indicator again. We would go to inputs, and then you could just overwrite that as false. And then what you would have is, again, you would just have the commercials that are shown here. And if you were to see the net positions of the retailers, then you would add study. And then you have a Campo COT retail trader, should have that as well. And then you would see the net positions of those retailers. And then I could say, well, what are the users and producers doing? If you ever get that they are overlaying each other, right? That they're put in the same category, in the same graph here, then what you can do is you can double click on either of them. You can go to scaling and you can put them into another subgraph. So this would be subgraph 1, this would be subgraph 2, this would be subgraph 3. So I would put this to subgraph 3. Now it's my index that's kind of got out of whack, right? And my index I would now put at subgraph 3, 4. Reset. Here we go. So now as well, by just looking at the nets, I can kind of see that, well, the retailers and the commercials, they kind of do the same thing here as well, right? And you can see the nets here on the retailers as well, 221. Wow, that's pretty small, right? 221 contracts. Of course, they're not going to make a huge difference here, right? Versus the commercials, 60,324 contracts overall that are on the table. So the extremes, they're pretty wide apart from another in terms of just the net sizes. So then if you want to remove them, you could just remove them again. Don't need them. And we could move on from wheat, because wheat, we now said, well, we don't need the commercials. And then we're putting this here, NA, NA, NA. And the only thing that's missing for wheat now is the when. And once we talk about seasonality, then we can say when right? And once we can say when, and we know supply and demand, we can make a full analysis of wheat, and we know what works and what doesn't work. How beautiful would that be, right? We have a blueprint just for wheat. We know the fundamental drivers. We know which ones work the best. We know which ones don't work. And we've got a full blueprint. That's the goal. That should be your goal for all of the markets that you want to trade. And in the beginning, maybe on that, it's best if you just pick out 5 markets that you are really interested in. It doesn't have to be 20. It doesn't have to be all markets under the sun, right? It can be gold, can be crude oil, and then maybe the Dow Jones. You have 3 markets and you follow them religiously, and you write everything down. You write down your blueprint. And as you know these markets by heart, then you add additional 3 markets to your list of markets. And then as your experience grows, and as your screen time grows, and as you become a more well-rounded trader, the more markets you're adding to your list of potential markets that you're trading. And also within the live trading sessions and within the grid prep sessions, you also want to be paying attention to the things that we generally look at. Okay. So we can really, I think, put a check mark on wheat for now, and then we can move on to some other markets that we may want to take a look at. Let's take a look at silver, because silver is one of those markets, just like gold, where you have these 2 so-called camps, right? You have the bull camps and the bear camps. And there are only a few markets that I know of where those kinds of camps are fighting off their positions so vigorously and religiously, right? The bull camp, they're basically arguing for wildly, increasing prices of the precious metal markets, and they're basically calling the world to end, and the sooner the better. And so there are only a few markets that are like that. And so for those markets where they are popular for retail traders, you will find that when we look at the retail traders, and doing the opposite on those markets usually works pretty well. And silver is just one of those markets, so it makes a lot of sense. But before we even look at the retailers now, there's a whole flow of a process that actually we have to undergo, right? So, and we can do that as well together, just to also refresh our memory here. And so, of course, we would start with location, and we can start with the weekly chart here if we were to do weekly income. And then we would say, well, let's find some demand. And I would look below to find some demand. This is just the first demand that we can find here. A drop base rally. And then let's look to find some supply as well right here. And what you basically can see is that I'm visualizing at the moment, right? So down here, it's a drop base rally, and I do have an explosive candle here or a decisive candle here as part of the base. However, what the market is doing clearly is it's dropping, then it's basing, and then it's clearly rallying. So I have that U shape here very clearly. And then I'm just going to try to wrap my lines around the U shape as best as I can. If you said, well, I'm only seeing this here, why don't you put the proximal here? Well, you could, right? I wouldn't have a problem with that. It just then becomes a matter of how you visualize that area. And remember, location is all about the higher time frame context of price. So this is where we're going to decide on what's generally cheap and what's generally expensive in terms of price. So we don't have to be very accurate here, right? We don't want to set these areas. We're not speaking about placing trades yet. We're just speaking about gaining a better understanding of where price is most likely to turn. We're not speaking about optimizing our risk to reward ratio. We're speaking about optimizing our accuracy, our probability of success. So here we have a demand zone, very visually very clear, even though scientifically we don't have the right candles within that. And then here it would be the same thing on the weekly. Well, we may have probably we have a rally and then a base and then a drop is what we have most likely. And so if we had that, then I would probably have to say, well, I have to put my distal up here. Well, if I put my distal up here, then this is a pretty large area. Yes, we want to find large areas to get an understanding of where price is most likely to turn. But here, this is just way too large, right? It's way too large. It's from 25 all the way to 28. So it's $3 zone. So we do have to refine this potentially a little bit. And so as I visually approach this, I may say, well, we have a drop. We also have a drop, a base, and then a drop, right? And so for a drop base drop, I put my proximal around all the basing candles. Now you could say, well, why don't you put it here? You could. I just put it here, and then your distal goes at the highest wick of the basing candles, including the leg out. This is part of the leg out, so we would put it here. So it's just how you are going to visualize it as well. Usually when you have a very let's say, unpretty or ugly zone where you have to visualize a lot, whenever you start visualizing a lot, there's also no point in trying to use very scientific rules when you visualize, right? Because we use scientific rules to be really accurate. And that makes sense if we can be scientific with the zone as well. But if we can't be scientific with the zone as well, we also don't have to be very scientific with the way how we're going to draw the zone. And so generally my rule of thumb is, I get asked this question a lot, how do you draw your zone? Why do you choose this candle? And why do you not choose this candle? Or why do you not choose this candle? Or why you not choose this candle? I get asked this question a lot. So generally you can write this down. When the zone is ugly and when I visualize a zone, I use the first candle prior to the leg out as a reference mark. Okay, that's what I do. And so you can see here, this is the first candle prior to that leg out that I use as a reference mark, where I put my proximal at the lowest body of. And then I just have to put my distal here, in this case, on as part of the leg out. But if the leg out was smaller, then I would also use this candle here as a part of the leg out, right? So that's usually what I do. I use that as a reference. And then I use whatever would be the highest wick here. In this case, it's just here. Here, it's the same thing, right? You could be asking, well, why don't you put it here? Why do you put it there? Well, it's the first candle prior to the leg out that I use as a reference. Okay, and usually that works pretty well in terms of further pinpointing the origin of imbalance if you have to visualize and if the zone is rather ugly. Now we have a supply and a demand zone. And now what we can do as well is we can divide this area now. $33 and $66 from distal to distal. And now we are getting 3 equal parts as a location, and we're getting 5 different parts. So what we have is we have a very high. We have a high, we have a equilibrium, a low, and a very low. All right. So job one, done. Now we move on and we do the direction analysis. And I'm just going to remove the commercials for now, so we have more space. And I would just use 1, 2, 3, 4, 5, 6. Okay, so 6 is enough. I could now sense check those pivots if I maybe should be using smaller pivots here on the weekly. I could sense that also in potentially changing the inputs maybe to 5, just seeing what visually may be happening. Okay, there. Here it sees an additional 1, but here it doesn't see an additional 1, and here it also doesn't see an additional 1. What would happen if I put this to 2? Okay, also not a whole lot will change. So I would rather stick with what I had originally here, 10. And now from left to right, I could give them names, starting with here. This is my low. This is my high. This is higher than the prior low, so I have a higher low. Now I have a higher high. Now I have a higher low. And now I have a higher high again. And lastly, I have a higher low. So what I have is I have an uptrend here, right? I have a very clear uptrend here. So what price is already trading at a potentially at a higher high here. And so I have a very clear uptrend. So already my default setting is, in terms of the technical analysis, my default setting is, well, I generally do not want to trade against the trend, right? Well, even though I'm very high, I'm in supply, I generally don't want to trade against the trend. It's an uptrend. We have 2 consecutive highs. Higher lows, 2 consecutive higher lows, which is in this case the definition of an uptrend. So generally, what I want to do is I want to buy. Even though I'm in supply, I want to buy. I want to buy with the trend. Unless, and here's where now the commercials will come into play, unless the commercials were down here selling, not just down here, but at a extreme, right? Because now basically it's counter trend, so we need the commercials to be at the yellow line, right? So guess what? We were low, we had a higher low, we had a higher low, and as per your commercial set of rules is your next buy point at this stage, once you have an uptrend, is once the commercial hit the green line again. They hit the green line right there. That's when you say, well, now we buy, and now you basically with that predicting the higher low. I know, unfortunately, we weren't able to predict it this time around because the COT data wasn't available for the past weeks due to some cyber issues at the CFTC. And so unfortunately, we didn't have that data available here. However, if we had that data available here, it would have been very clear that we're at an uptrend. The commercials are buying, and then we also want to be buying within an area of demand, right? So that's what predicted that higher low here. And now what are the commercials doing? Well, now they're slowly distributing as price goes higher. However, what's very interesting is you would expect the commercials to be, much lower by now because they're already at a new high. So it seems like they may have a little bit more power left here, right? They're not even at the opposite extreme just yet. And that makes a lot of sense here as well. As we come from this extreme here, where we were at 3-year extreme of the commercials. And now if I'm going to load in the users and producers, what we actually saw here is that the users and producers were at a total of 4,500 net positions. So I have a golden rule when it comes to the precious metals, and this is also what you will write down now, and I'm going to write this down here as well. Golden rule, precious metals. If net commercials are net long, it's the ultimate buy signal. Okay, if net commercials are, well, if net commercials. If commercials are net long, then that's the ultimate buy signal. Okay, so here we can see the 0 line. They were at this point, let's just put this to 0 exactly. At this point, they are above the net 0 line. When they get close to it, and you maybe want to also have some precious metals in terms of your safety deposit, you have a large amount of capital, or you want to invest in the long run in terms of precious metals, and you're a precious metal fan. That's when I will join the bull camps that are usually screaming for higher and outrageously higher precious metal prices. That's when we will join them, right? When the commercials are at these net long readings and when they're close to them. That's when we can go in and we can say, well, now I accumulate for the long run, I buy and hold, or of course, now I implement one of our weekly or daily income strategies here, or monthly income strategy, and we buy it leveraged on the way up. And then when they're up here again, with the trend that had been formed through that net long reading, and they're close to net long again, they're above the green line, then that's when we want to buy again. And so net long is something that is specific to precious metals, right? And so when these are net long, we can see this here. This was a major rally. We can see this here. This was a major rally, right? This was back then a major rally. And they've only been net long a few times. I think these may have been one more time net long. No, that's it. Gold has been net long once more, but they've only been net long 2 times in all of history. And both times were the beginning of major bull markets. So basically, here was the beginning of a major bull market as well. And that bull market would have stretched to here. However, there was one outlier, which was Corona, right? So there was one outlier, which was Corona, but also kind of the commercials were expecting that, because at that point, they were at a rather extreme reading relative. So they were kind of expecting this, but generally these net long readings, even though the commercials flip-flop after relatively quickly, what they will create is they will create long-lasting trends, right? And so we had that here again. And so this has to create long-lasting trends. And this is just the beginning. So we're just the beginning of a new uptrend. And so what we want to do is we want to buy all those green readings that we can get our hands on. And so we could now say, well, these net long readings, these are the readings where we want to join these bull camps, right? That are screaming for outragingly increasing prices. And however, if we're now going to look at the COT net retailers and we take a look at what they're doing down here, then what we can see is, well, damn, they're not so, their camp, they're not so bullish, are they? Well, look at where they were. They were down here. When was the last time they were down here? In 2017. Not a good time to be a seller here. Price just rallied after. So here as well, price just rallied. So whenever they're down here, it's not a very good time usually to be a seller. So we can see, historically speaking, when they're down here, that's not a good time to be a seller, right? They are very fearful at the moment, or they were very fearful in 2022. And just prior to Corona is when they had been accumulating for many years, right? So if you look at the other extreme, the bullish extreme, then they were up here, and up here is a reading that they didn't show for years and years and years. And guess what? The only time this happened was here in 2006, right? And then before that as well. So very rare readings. And then when this happens, when they're super bullish just prior to Corona and the commercials are super bearish, then usually the market drops and so on and so forth. So usually they're rather wrong. They do the wrong thing at the wrong time. They're not always wrong, right? Just as the commercials are not always right, but the commercials are the most consistent player. They're the least consistent player. Okay, they're the most inconsistent player. They're the most consistent loser. They're the most consistent winner. So if we want to have the best odds, then we follow the most consistent winner. And even better, if we have the most consistent loser on the opposite side. So how this then would look like in terms of our index. We would now put our retailers in, and we would now see that usually the retailers just do the opposite of what the commercials are doing, relatively speaking, right? Relatively speaking. So down here is when the commercials turned really bullish, and that is when the retailers turned really bearish. Here is where the retailers were really bearish and the commercials turned bullish, and then we got this nice little rally. So there's a lot of points that we can just pick, and the analysis here is similar to wheat, right? So here we would have a pretty large sideways trending market. So you could always do kind of both, right? You would do kind of both. And so usually when they're on the opposite sides here, that's when you get, commercials are buying, then they're selling, then you get a rally, then the commercials are selling, they're buying, then you get a decline, and so on and so forth, right? And so on and so forth. And then a reading here doesn't get a lot better, right, than this. Post this extreme. And here's an example where if, you're here and the commercials are buying, but the retailers are not on the other side. it doesn't mean that you don't have to take the trade, right? It doesn't mean that you don't have to take the trade. Again, the retailers, they're not always wrong, right? Sometimes they're right. And so nobody is wrong all of the time. And so in this case, you could buy regardless of the retailers being in the opposite extreme, right? But again, the much better setup, of course, is when you have that opposite alignment or that divergence, we would call it. So now we can summarize. Price is considered high, very high. We are in an uptrend. Do we want to sell this up here? Not as per right now, right? We don't want to look to sell. Why? The only way we would sell this is if the commercials were down here. That's the only way, as per the rules, where we could sell against the uptrend because we're trending up. However, if eventually price goes into low, right? If price goes into low and the commercials go above the green line again, so the commercials are above the green line and prices low or very low, in line with the commercials being up here with the uptrend, then we better buy this, right? Then we better buy this, all stars aligned. And ideally with the divergence of the retailers also being sellers. So the retailers being sellers, commercials being buyers, price is in low or very low, and the trend is up. That is the perfect scenario that we would want to buy this with. That would be an ideal setup. Do we have a setup to sell this at the moment? Not right now, but maybe in the near future, in a couple of weeks, depending on what the commercials are doing. So each and every week, we have to go in, we have to reevaluate based on what are the commercials doing, what are they not doing. And based on that, we would then go ahead and reevaluate. Now let's make another example. Let's look at natural gas. Natural gas is quite interesting. And the first thing that I want to mention about natural gas is that if you are using symbol at NG, you may be seeing this chart right here. This chart right here is quite misleading to what is actually happening. So there are these so-called unadjusted continuous charts, and they're custom. And so to really understand the backdrop of unadjusted custom continuous contracts, you would have to watch the full futures course. For now, just understand there are two different futures charts that we can look at. We can look at our custom charts, which are the recommended charts, and you can look at these simpler charts, which are a lot simpler to put in. However, they sometimes, for some products, give you, different charts. Now, to understand this fully, you will at some point watch the futures course, and once you watch the futures course, you will get an understanding of that. For now, I'm not so worried about your understanding of the futures markets and what makes up those symbols. I'm more worried about you trying to understand charts in general, not talking about the complexity of the symbols themselves, right? Because that's just then focusing on the wrong thing at the wrong time. But I do want to show you that there may be two different charts that you may be looking at, depending on the symbol that you're putting in. Now, my recommendation for natural gas is going to be at NG equals 103 XN. And what you now can see, the chart looks very different, right? We're not at an all-time low. We're not near an all-time low. Well, we are near an all-time low, but we're before the chart was down there, right? So if I'm going to put now, just for you to see that again, so, right, very different chart here versus here. Even though we're looking at the same time frame, we're looking at NG equals 103 XN. That's the custom continuous contract, the one that we force rollover on before a certain day of expiry or notice. And then here it's just the TradeStation default chart. This is the recommended one. You can see this is the true chart. This is the institutional chart. Here you can see this is very misleading because it would say, well, we're in an all-time low. However, hey, we're not, doesn't make sense for natural gas to be at an all-time low, right? So it does these kinds of custom symbols, they don't matter on all charts and on all markets, but for some markets, they really do matter. Now, natural gas is just one of those markets where this would matter. And so I just wanted to show you how this would look like. Now, just to double check if I have the right one here, let me just load one of my workspaces. Yeah, 103 XN, perfect. All right. So here again, now we can do the analysis for natural gas. Starting on the weekly, we would say start in current price, go down below, and then find some demand. Here I do have an explosive candle. However, I don't have a base, right? I would have something here, but if I was to put this in here, then price already tested this area, so wouldn't be fresh anymore. I have to go down further, and now I have to look at this here. And here I have something that I may be able to visualize as either a rally-based rally. So I could say, well, what do we have? We may have a rally-based rally here. We could also say we have somewhat of a drop base rally as well. I could also say, well, we have a drop base rally, also possible. So as I'm now working on the higher time frame, again, there's going to be multiple solutions on how you could be visualizing this. And as we're talking about visuals again, I would look at the explosive candle, and I would use the one candle prior to that as a benchmark for my proximal line right here. So, and then my low, depending on what you see as a leg in. If you see, for example, all of this as a leg in, or if you see this as a leg in, and then all of this is your base, regardless, this is the lowest point of all of that low. So here we have full coverage. But if you were to say this is a rally-based rally, We could put it here as well, right? If you were to say this is a rally-based rally, I'd be fine with that. I'd be a little bit happier personally with this one. And then we would say, well, is this fresh? Well, it was touched here. Is it touched by more than 25%? Probably not, right? We don't have to get the measuring tape out, but it's probably not touched by more than 25%. Plus, it's the all-time low. I can't go much lower than this, right? So this is all I've got. And now we're going to look at supply as well. And where do I have supply? There may be some supply here. Also visualizing this as a rally base drop. I understand this is not a pretty one. Let's just assume this is not one, right? We don't see this one. So what we're doing is we go to the left. We've got a lot of drops, drop here. And then here's something going on. We've got a drop, base, drop. And here you would say, well, Jan, what do you do here? This is a bit crazy. We've got a drop, base, base, drop. So where do you put your proximal? You put it here or you put it here. Well, if you ask me, and if you look at, again, my rule that I gave you before, the rule of thumb is you use the candle prior to the leg out. So if this is your leg out, use the candle prior to the leg out, which would be this one. And then you would put your distal here as the highest wick of the basing candles. And then you would have a level there. Now you could say as well, Jan, what I'm seeing is a drop, base, drop. I would say, okay, fair enough. That's really bird eye view and higher time frame stuff. Okay, what do you do? Well, in this case, this would still be my leg out. So this is still the candle that I would use as my leg out. And the only difference here would be that I would put my distal up here. I wouldn't put my proximal here, right? Because when I put my proximal here, then I've got a very large zone from here to here, right? We wanna pinpoint supply and demand. We don't need to be super accurate, but I also can't work with half of the chart, right? Because then I'm not really pinpointing. I'm being very vague. So there's a balance between being vague and trying to pinpoint as best as possible. So let's just say, for argument's sake, we leave it like that. Okay, and then maybe we make it slightly bigger, right? We could use this candle here as well as part of the base. Now we could put it like that, just have a little bit more space here in terms of the supply. And you can really see I'm not very scientific as it comes to my higher time frames. I'm being more contextual. I'm being more bird eye view. I'm trying to visualize. I'm trying to really understand where could be unfilled orders in terms of where's the origin of potential major imbalances that had happened in the past. And so up here, what I understand now is this is pretty nicely looking. Yes, I've got a nice leg out, right? That's always very important to have nice leg outs. However, this is very, very far away from price. And so for me to narrow down my location chart as well, I probably do want to go a little bit closer to where current price is. And so if we do that, then we probably end up being here, because that's the only kind of supply zone that we see in the meantime, right? This is all we got. So we have got a choice to make now. Is this supply, or do we use this as a supply? Probably what we can do is we can use this as a supply for the meantime. However, we know that this is the quality supply, right? But if I do my location analysis, what I'm going to do is I'm going to use the first two. And here it's really whatever looks like a level is a level, just because this is so far away, right? A 300% rally, 200%, 300% rally in price from 2 to 6. So that's not going to happen in the next few weeks. So I need some other things to work with. Doesn't mean I'm going to sell here, right? Doesn't mean I'm going to sell here, but just to be aware that there may be some supply here on the way up. So 33 and 66. Now I have a nice little window here of opportunity. I have a very low. We have a low. An equilibrium. A high. And a very high. All right, now we can move on. Price at the moment is in an equilibrium anyway. So let's see what the trend is telling us and what the commercials and the retailers potentially are telling us as well. I do want to start with only the commercials in this case. And what I want to understand is how accurate are the commercials really? Are they doing a good job of predicting, at least within this uptrend, decent highs, you know, or decent lows? So down here, they're selling, price rallied, not so great. Down here, they were selling, price was at the bottom, not so great. Up here, they're trying to buy, and then here, even more so, and then they bought and price rallied for quite some time. And then here, the trend is up, so they're not even going into this extreme here, and then here they're buying again, and this is the all-time high. So already by just testing a few, what can we say? If I was now to go in my Excel spreadsheet and I would use the commercials as a primary tool, fundamental tool to look at natural gas, well, I would not have a lot of accuracy here. Not so great here, exactly neither. So already I know, hey, maybe I should use some of my different tools to be very proficient here, to have high profitability and high accuracy. What I know is, what I can filter out is already, well, maybe using the commercials, at least within that index that we have, within that calculation, using it that way may not be a very good idea. Great. So also understanding that something is not a good idea is as an understanding, right? So what we're doing is we're putting a false there. And now it's empty. So what I'm now going to do is I'm going to put the speculators in. And let's see what these guys are doing. So let's see. Here they're at the yellow. Okay, here they're at the yellow. Here they're at the yellow. And then here they're at the yellow. And then here they're selling, 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 not so good. Then here they're finally buying, but then price goes down. Then they're finally buying again, but then price goes down. Then they're selling, but then price goes up. Then they're buying, but then price goes down. Then they're selling, but then price goes up. Then they're joining the trend, which makes sense. But then all of a sudden they're down here. Why? Right? Then price continues to go up. Then they're like, okay, let's go back to buying. And then it goes down. And then it goes up big time. And then they are like, hey, now we finally figured this stuff out. And then from there, we get a massive turnover in terms of price. So here as well, here, this one is a lot better than the commercials. It's not perfect, but a lot of times we get the opposite of what the retailers are doing, right? Because if the retailers here are buying up here, that's not a very good idea, right? And so, however, they can be wrong at times here. They can be right at times here as well. Then they're selling, and eventually, as they're selling, price rallies, and then eventually they're buying, and when they're buying, nothing much is happening. So here also, it's not so accurate, right? Looking at the calculation here, as Nader is phrasing it, this one bites the dust. And here's also where I wouldn't look at this just as a standalone tool, right? So also here, the calculation that we're looking at is not so accurate on what is happening here within this market. So what is left to do? What we did see, however, is that when it touched the yellow lines, that was pretty important most of the time. So it's the bigger extremes, not the smaller extremes, that are working really well here. So what I'm then going to do is, well, let's take a look at the retailer's net to see what are some extremes in terms of the nets, right? And so if I want to find out what created this high here, right? So if I want to find out what created this high here, and I look at the retailers, and then that is my extreme. And if you were following us there, that is what we called here on the way down. And also that's what we called on the way down as well, right? And we shorted this on the way down. And the reason why we shorted this on the way down is because at this stage, the retailer were at a historical high in terms of the net positions. Okay, whenever they're at historical extremes, that's what we use as a standalone tool. That's where we are going to go against them, because we know that these guys, they shouldn't be making money. The entire institutional world is geared towards manipulating and making them losers. And we're not the only ones that are seeing this, right? So if the large traders are seeing this, then this becomes a self-fulfilling prophecy eventually. So then we check, well, what's the baseline here? They've been, well, let's be accurate. They've been close to here, there. Here we got a little bit of a sell, but not too crazy. But then where we really were at these extremes is here. Here it worked a little bit. Here it worked a lot. Right here it worked a lot. Here, eventually also we turned into a multi-year, well, at least for a full year, into a bear market. And then we get this another few times, where here, for example, this reading was the high of the high here. This reading was just a little bit of a sell-off. This reading was just a little bit of a sell-off. This one was just maybe a week, but they were pretty damn accurate here. So this one is probably one that I would book as a not so great. And then here as well, price just kind of went down over the long run and or sideways. And so now we have an extreme, a close to a historical extreme, where we could say, well, if the retailers are up there, then this only happened once, 2 times, 3 times, 4, 5, 6, 7, 8 times. And out of those 8 times, we had a few times, well, the major pivots that we ever saw came out of these readings, right? And then as well, we have 1 winner, 2 winners. Here we could call it as a winner or not, maybe not so great, depending on for how long we would trade it, but we would have 1, let's just call this a loser, 1 loser. Here we get a winner. Here we get a winner. Here we get a winner. And then we call this as a loser, this as a loser, and maybe this as a loser. So we have 1, 2, 3 times where it's a loser, and then we have all the other times 1, 2, 3, 4, 5, 6 times where this is a winner. So it's around 60%, and the times where it was a winner, it was also very, very profitable, right? Very, very profitable. So it's about the retailers here. Certain readings of the retailers in terms of COT net extremes, maybe not the 3-year extreme and definitely not the 6 months extreme that we saw that have a lot of accuracy. But then we have to do the manual labor and say, well, what are some really big extremes? Maybe it's 5-year extremes, right? Maybe if we change the indicator to a 5-year extreme, we would then get that. But these are the things that we have to manually track and say, well, if the retailers are here, I'm not gonna, at least, the least thing I'm gonna do is buy. But also what I can do is I can look to sell, right? And then if I'm looking to sell up here, eventually we can see we get a major drop of price that hasn't stopped until today, right? That hasn't stopped until today. So here we would then put into our, if we were to put in natural gas here, we would say, well, commercials, not really so important. And then we would say retailers, the only thing that's important is those 5-year extremes or those historical extremes, if you will. And maybe within the 80th percentile of the historical extremes is when we want to look to go against them, right? And then you have your fundamental strategy that doesn't work as great as the commercials work on wheat, right, in terms of the accuracy, but it's the best that we have, right? It's the best that we have. And then maybe as we overlay that with the seasonals that work extremely well for natural gas, as it's an extremely seasonal market, then for natural gas, for example, your blueprint will be, well, seasonality and retailers as a longer term fundamental tool, the retailers for sure, but as a shorter term, we're just going to use the seasonality for the natural gas market. And that's something that we can do then as well, based on the data, based on our findings, and based on our back tests. So our blueprint, as you can see, may look very different on natural gas than it does on wheat. And then it looks again different on silver than it looks on wheat. What we said on silver, and maybe we can do a little bit of a cheat sheet here for some of the markets that we covered already, just like a cheat sheet, just to keep track of what we're stating here. And then we're going to end it on this because we're saying so much and we want to keep note of this as well. So first we checked silver, right? And on silver, we basically said that the commercials, they are our primary tool, and we can use this our index strategy, and the retailers, that's also applicable, and so that's all applicable, and And so that's for silver. That's our primary tool. And we look at the retailers here as well. And then on natural gas, that's not applicable. That's not applicable. That's not really applicable. The retailers are applicable, but it's net historicals, and we get them very rarely. And so we have to find out what else is going to be applicable. Maybe valuation here is more applicable. Maybe the seasonality is going to be very applicable here as well, right? And so when you, for example, look at certain markets and you're like, oh, this market is really not, I'm really not doing so well in this market, very likely is that either you're looking at the wrong tools or you're looking at the right tools, but it just so happens that even the right tools don't have a very good track record of predicting the future. In this case, it's not you that's the problem. It's just the lack of the tools that we have available to do proper forecasting. That's the problem, right? And so if we have a market like wheat and a market like silver, and you're like, hey, I'm really struggling in forecasting this market, then I have to say, you may be doing something wrong here, because the tools that we can see that have a very robust track record, you can find this out by back testing yourself. The forecasting tools that we use have a very robust track record of predicting the future with a very high accuracy. So if you use them the right way, then you should also have a solid accuracy. And if for those markets you don't, then you're doing something wrong, then you as the driver are the problem. However, if you're trading a market like natural gas and you're struggling and you're saying, I really don't know what the issue is, I'm using these tools, but it just doesn't work out for me, then I have to say, well, those tools also, if you just do a spec test, they don't have a very robust track record. And there may be other markets that you could focus on instead. And then you take a look at those markets, and then you only touch them when there is a rare example of an extreme that you can then trade, right? Or alternatively, because here we're talking about weekly income analysis, right? Alternatively, you just use supply and demand and seasonality if nothing else works, right? Then you have less checkboxes. You have probably less probability in your favor. But if you are a good technician, then this can all, and you just apply seasonality on top of that, that can also work out pretty well. Probably not as well as if you align all of these things, but for some markets, we just don't have the possibility to align all of these things. So we have to use the best of what we've got. And then continuing to spin the wheel, the lower you go in terms of the time frame and in terms of your trades, right? If anyways you do daily income, and when you do daily income, you anyways, or even lower, you don't really care what the fundamentals are, because you're not predicting a weekly rally, right? You're predicting an intraday rally or an intraday decline. And the price action, the laws of supply and demand would overrule whatever happens intraday, as opposed to the fundamentals that would govern the higher time frame moves, the weekly and monthly moves, the A to B kind of moves, right? And then whatever happens within that A to B, those intraday volatile moves, if you're just using daily income or lower, then you're fine with technicals and maybe seasonality and so on and so forth. What else did we talk about? We also, I think, talked about palladium already. This is our primary tool. the COT index is applicable and the retailers are applicable, right? And so we can see for the precious metals, makes a lot of sense that this stuff works. Wheat, makes a lot of sense that this stuff works. Natural gas, we checked, it just doesn't work. We have to use other things. And then we also did Netflix and a stock. And here it's not applicable because we can't look at commercials. It's a futures only. So it's not applicable and it's not applicable, right? So for Netflix, at the moment, we just did the location and the direction stuff. And that worked really well, right? That worked really wonders. If we were to put here, then, for example, if you, for example, don't have this, then you're going to say, well, uptrending and low combinations, how are they working? Downtrending and high combinations, how are they working? And so in the case of natural gas, if you were just to look at technicals and you were to say, well, when I have an uptrend that is being formed, and then I have weekly demand, how well do these weekly demand areas work? And then when I have a change of trend and I trade weekly supply, how well do those weekly supply areas work? And how well do my counter trend areas work as well? And usually if you have high quality supply and demand, that works pretty well. But again, I'm a big fan of really trying to find those markets where you can align fundamentals that have a robust track record rather than just trading the technicals. But it is important here. And, I'm picking natural gas here on purpose because I understand that natural gas is very difficult to read, if not very hard to find a robust, really, really robust fundamental tool to predict the future, right? Based on the things that I've taught you so far. As we continue with true seasonality, you'll find better things that can predict the future for natural gas that we'll then use. However, what we have so far for natural gas, maybe not that great of an idea. And it's important for me to show you those two extremes, right? So I showed you natural gas where it was like, oh, it doesn't work at all. You would be better just doing the opposite. And then you have a market like wheat or palladium or silver, where you have a very solid accuracy and track record. And so you have those two extremes. So it's your job as a trader to figure out what fundamental drivers are the primary drivers that drive the markets that you love to trade, right? And become an expert at one market before you trade all markets under the sun, right? Pick out 3 markets, 4 markets, 5 markets, become an expert. Write down everything you can find. Make an Excel spreadsheet once to put it on paper. You don't have to maintain it, right? It's unrealistic to maintain this kind of stuff for all the markets manually. We need a computer to do that. But it does have a lot of teachings in terms of what works and what doesn't work for all of those markets that we love to trade. So summarizing, the retailer, they're speculators. They're just gamblers. They're not always wrong, but they're the most consistent loser in the game. When they're extremely fearful as a group, market is near a bottom. And when they are extremely bullish as a group, market is near a top. Not always, but most of the time, for not all markets, but for some markets, right? So that concludes today's session. I'm going to end the recording right here and there. Thanks for watching. Thanks for staying until the end. You can continue to hang around if you have questions. If not, thanks again, and I'll see you soon. Ciao.